Hello, everybody. I'm Andrew Beaudry.
And I'm Ryan Cummings.
Welcome to Your Bread and Butter podcast.
Today is Year-End Tax Planning Part 2, Business Owners and the IRS. Frenemies?
See you soon.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Hello, everybody. Welcome back to Part 2 of our year-end tax planning. This time it's for businesses.
The goal of today, like the last episode, we're going to discuss some of the changes to the recent tax law with the new tax bill that was put in place earlier this year, how they affect specifically business owners, and what are the things that you can take advantage of, that you can do to, take full advantage of these deductions, these credits, these write-offs and strategies to try to be as tax efficient as possible.
Now's the time, after October 15th, to sit down with your accountant as a business owner and try to work out a strategy that best suits your business. I know that one of the things I learned about Santa Claus's accountant was very surprising as to how he valued the company. Do you know how he did it?
I don't.
The accountant used his net present value. For all
that
of
makes
you,
sense.
For all of you NPVs out there.
Yeah. Well, the goal, the goal of today is going to be to try to, like I said, get ways for business owners to reduce their tax and lower down their overall income, because no one wants a high pre-tax income. They say that pre-tax income is nasty. Do you know why?
I don't know why pre-tax income is nasty. You'd think that'd be great.
Because it's all gross.
That's a good one. I like that a lot. All right. Well, we don't want it to be gross for you when you sit down with the IRS if you go through an audit. So we don't want that to happen. Again, we're not tax planners in the sense of having certifications in that. We can advise in general, but you got to go sit down with your CPAs and the others that really know your business and know how to work your business, because every business is different as to how they do inventory and how they do all kinds of things. So let's talk a little bit here about what's changed and new and why it matters. And so the first one here is we're going to talk a little bit about the qualified business income deduction, which is section 199A. This is a 20% qualified business income deduction for pass-throughs. This would be sole proprietorships, partnerships, S-corps. It's now permanent, and your tax planner should know about this.
Yeah, it's a 20% write-off. So your business, brings in $1 million. Well, there's a $200,000 tax write-off that is going to happen right off the bat without any other expenses needing to come into play or any other tricks or this and that. It's a permanent one that was put in place, back in 2017, 2018, and it's now, like you said, made permanent. It's something that can be stick around, is going to stick around at least for the foreseeable future. And it's something that actually helped, I think, spark a lot of business growth over the last 5, 6, 7 years that I think we talk about all the time. And it's going to allow a little more consistency for business owners. You can track your budget.
It's been a big winner in our tax code for businesses and for employees as well. And I know in our company, we've taken this 20% since it's been available, and we've put it right back into the company as far as expanding our technology, expanding our employees, expanding the ability to serve our clients. So most businesses will take that and not just see it. Now, there are income phase-outs and adjustments, but again, you got to sit down with your CPA and get that advice properly. This is a really big deal. If you're not taking advantage of it, you should.
You should. And alongside with the qualified business income deduction, there's also additional bonus depreciation. Now, this was something that was brought in a few years at the beginning of the Tax Cuts and Jobs Act, kind of phased out, and they just re-implemented that. And the kind of the goal here was some additional motivation for business owners to continue to grow and build their business. Because what this is, for those of you that aren't familiar with it, is it's the ability to write off the full cost, 100% depreciation on business assets. So, let's say you go out and you buy a whole bunch of new office supplies, new desks or whatnot. You can write off those full costs. Or if you're a farm owner and you go buy tractors and farm equipment, the old law, you would only be able to depreciate parts of those each year over many years.
Right.
Well, now we've changed that where you can write off the whole thing all at once. And again, the idea there was to incentivize growth and investment in business.
Now, there are some assets that don't qualify, so you have to be careful about that. But it should help a small business be able to deduct capital expenditures more aggressively, which improves cash flow in the end. And be careful, though, because you want to make sure you qualify. Don't go out just spending money and then go, oh, no, I don't get a deduction for that. That would be worthless.
Yes, it's only specific assets. So a big point there. Now, we also have additional deductions for research and experimentation costs. So full expensing and deduction of domestic R&D, R&E costs for the full tax year beginning on January 1 of this year. Small businesses with up to 25 million average gross receipts over the last 3 years, they can elect to retroactively expense some of these R&E costs for tax year even going all the way back to 2022. So, again, some additional additional deductions for business growth. I think that's kind of the theme of, a lot of these deductions. It's a focus of the, I think kind of the whole purpose or the spirit of the Tax Cuts and Jobs Act that was originally put in place.
And this is really geared towards the small business. That's why it's up to the $25 million average of gross receipts. That's why that's there. This is not for the big corporations. But if your business invests in any kind of research, product development, innovation, it can produce a lot of good, it's just really healthy tax savings. But you have to keep careful records. And the small business R&E election may require adjustments to your prior returns as well. Now, I do want to remind business owners out there that there are firms that go out there and they're running a scam on some of this. And, I get these solicitations, if not weekly, daily, from companies trying to say, hey, we can get you R&D and R&E, we can get that up. But you got to be really careful because when they push something like this goes back to the, pay to play or play and then pay mentality. You got to be careful. This is where you want to keep the IRS as your friend. Don't make them an enemy by, juking on your tax returns and making something up that's not real, because that will come back to bite you. So instead of a friend, now you got an enemy in the IRS that's coming after you because you jury-rigged your tax return.
I think that's an important piece to understand with a lot of these deductions. I think we find it all too often that business owners, sometimes like to try to take the maximum advantage
Be aggressive,
around these deductions. And don't get me wrong, there's nothing wrong with that. But the tax system is self-reporting, meaning you can say and you claim or qualify for whatever you want, but when the IRS comes knocking with an audit, and business owners are some of the higher audit rates in the country, that's when you have to prove that you qualified for these deductions. So, again, to your point, be careful what you're actually taking. Make sure you qualify because, it might work 1 year, 2 year, 3 years, but if in year 4 the IRS comes with an audit, well, you're going to have to prove all that past history.
Exactly right. So be careful and do that. Now, business interest deduction is a very a good change to this tax code. So let's expound on that a little bit.
Yeah, they changed the calculation on business interest deductions. So they are essentially modifying it so that depreciation, amortization, depletion, they're now excluded when adjusting your taxable income. So it's essentially just allowing more business interest to be deducted on the year-end taxes. So in capital-intensive businesses that have debt, this can increase the deductible interest, less restrictive limits being the idea here, and reducing your overall taxable income. So less limits, more favorable calculation. Now, other limitations still apply, so you do want to still consult a tax advisor or CPA, but at the end of the day, the idea here is bigger deduction, less taxable income, more favorable, more income in your pocket for business development for anyone who's in these sorts of businesses.
And again, it's good to get good professional tax advice from a certified public accountant who can guide you in this, and don't just assume that what you read is actually what you understand. So
Now, there's also some changes with reporting in 1099s. So the 1099 NEC threshold for non-employee compensation, it was raised from $600 to $2,000. So this applies to payments, after 2025. The Form 1099-K, so this third-party payment reporting form thresholds, they return to 20,000 and 200 transactions for future years. So there's been some adjustments to these different income reporting and thresholds where you can, pay someone and maybe not have to technically claim them as an employee and, still say hire for certain services.
Right. And this is it can be a big deal, particularly the Form 1099-K when you're paying a third-party payment. They return to, $20,000 as far as that limitation and 200 transactions for future years. So this is a big change, and it reduces the administration for the small businesses, and it does really help as far as that goes. This is for many small businesses that use contractors and other third-party platforms, but you got to make sure you track and report everything properly underneath this new rule so you can take advantage of it.
Yeah, I think the spirit of this change is a little less regulation, a little more flexibility, a little less administrative burden on these small businesses to just give you more ability to grow without having to jump through a million hoops in the process. So that's kind of the spirit behind that change.
And our next one for small businesses is pretty interesting. This is the SALT workaround for pass-through entities. These are businesses that are pass-through entities, as we discussed earlier about some of the business income deduction or credit for income that's not taxable. But you may be able to, as a small business, as a pass-through entity, may be able to deduct state and local taxes right at the business level, which works around some of the limitations on the individual SALT deductions.
It does, and this can provide some meaningful tax relief, especially in those high tax states like we were talking about in our last episode. You're New York's, Massachusetts, California's, and there may be rules about which types of service, though, businesses can or cannot use for the workaround, and income thresholds do matter. So you want to make sure that the business is structured appropriately when trying to take advantage of this sort of write-off.
And again, get that consult and advice. Now, there's other extended programs that have been made that are more permanent now. Several are favorable that originally were temporary under the original ones, but now the examples include for now more favorable. You got lower tax rates, wider brackets. You got a bonus depreciation, which is very helpful. And then there's some expensing rules that have changed just as we've been going through. And there's certain full deductibility of certain business taxes. This is a big deal.
It is. Just like with the personal side of tax returns, same with the business. A lot of these that were set to expire at the end of this year, they're permanent. They're now fully in place. Some are semi-permanent, I guess. Some are only a few years, but others are now a permanent piece of this tax law going forward. So it allows for more long-term planning and being able to kind of revisit your business plan, where you're investing capital, how you're planning your expansion, maybe trying to take advantage of some of these write-offs now, especially I think the big one is going back to it, the bonus depreciation.
Yeah, I mean, that's a big deal.
That one was temporary. There is temporary with the extension. It's not a permanent addition. So that means invest in your business now. Try to take advantage of some of these write-offs while they still are around.
So as you sit down here after October 15th with your accountant, you're going to make a list of these items that might have an impact on you. And again, we want to look at some planning impacts and risks so that you can really take advantage. So we're going to walk through some of that for you right now.
Yep. So like we were just mentioning, the bonus depreciation, big one. So higher expenses, time those expenses to be earlier, try to bunch those up either this year or next to take full advantage of that. And then also keep an eye for some of the phase outs and income thresholds. So for things like the QBI deduction or the additional SALT pass through, they still matter. You need to make sure that if you're going to take advantage of these, you have the right income levels. So, that's where making sure that you are investing maybe the right amount into your business, increase expenses if needed, invest a little more into the business. If you're going to be over some of these income thresholds, try to be creative with what write-offs you're actually claiming against your income to maybe bring yourself down to meet these thresholds and actually take advantage of them.
And watch for IRS guidance. You might get emails from the IRS, or maybe your accountant does and passes it on to you, but they were going to give guidance as to how to interpret these eligible assets or small business definitions. So you got to to be careful about that and be aware. And then possibly increased scrutiny on loss usage and aggressive depreciation. So there might be a little bit more auditable experience with the IRS if there's going to be more losses that are being used or aggressive depreciation. So you got to make sure that this is all legitimate. And lastly, some provisions are temporary. In other words, reporting thresholds effective after 2025. So use it while you can. So it's either use it or lose it. And I think that there's why these things matter so much to watch,
Right. So, I mean, with all these planning points to kind of summarize there, it's just a matter of evaluate your situation, make sure you're deferring expenses or proper income, deferring money into retirement plans, doing more some years, less others, to make sure that you're maximizing your tax efficiency while also still maybe making a profit on your business. And I know you don't want to be spending so much money that you're over leveraging your business,
right?
But at the same time, not paying too much in tax, because who wants to pay more taxes than they need to?
And it's always good to look at different scenarios, multiple scenarios if possible. And again, when you're considering that your business structure and what gives you the best tax advantage, you don't want to go so hog wild on that you find out, the expense of running this new structure is way too much compared to maybe other options. So you want to find out, is it going to be more expensive for me to set up a pass-through entity? Is it going to be something down the road where when I relinquish and sell that business that I'll have more taxation? So it's not just like a one and a done. Make sure you know exactly all of this. Let's summarize some of those planning tips for our business owners out there.
Yeah, so as we wrap up today's episode and just kind of give an overview of what we've discussed, some of the big things to take away, you'll see them on this slide here. But first and foremost, review your eligibility for things like the QBI and SALT workarounds like we were mentioning. Make sure you're timing major purchases to maximize things like your bonus depreciation. But again, it has to be those qualified expenses. You can't just do this with everything. It has to be certain expenses in certain businesses. Then also consider R&E expense elections, if applicable. If your business is in a field where some research and development or expenses like that can help your business grow, well, now's the time to take a bigger full advantage of those things.
Yeah, and you should prepare for a little bit higher 1099 threshold and update your vendor tracking, if you have a lot of third parties that you're paying, so that you understand that threshold and where it's going as far as reporting. Watch your income thresholds and watch those phase outs closely. Make sure, put them up on a calendar if you have to. Put reminders in your calendar as to when those phase outs. Make sure you work with your tax advisors to model multiple scenarios, and this is what you pay them for. They're the tax expert, so let them model for you. Yes, you're going to pay money for it, but that extra $300 or $400 to have them model that for you may very well save you thousands of dollars in taxes, as well as your own personal preference and your lifestyle. So,
and then lastly, just keep an eye out for the IRS guidelines, because like we discussed at the beginning of the episode, some of these policies aren't fully baked out yet. They're kind of proposed. The IRS comes up, or Congress comes up with these policies in this tax plan, and then it's up to the IRS to kind of hammer out all the details and come up with, what qualifies, what doesn't, what are going to be the specific limitations versus what aren't. And sometimes it takes, even a lot of times it can take until almost the end of the year for them to really finalize some of this stuff. And so that's something you want to keep an eye on. Make sure you're keeping an eye out for IRS clarifications and updates as they finalize these
and particularly
rules.
For the ones that are restructured for this current year, ending September 30th for some of the energy credits, things like that. There are things that are just going to end on a certain date. But if you're confused about anything, again, patience is the byword when it comes to that. What you want to do is you want to see the IRS as your friend, giving you these deductions and the availability. And again, you can use it that way. What you don't want to do is have them in your back pocket following you around because you've done something illegal. That's not a smart move. So we're glad that you listened and joined in with us today. And for all the business owners out there, if you have questions, you can definitely contact us and make sure that you know what's going on with you. Talk with your advisors.
Absolutely. I think that's a good point.
Yes. And remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to plan for tomorrow than you do today.
Thank you for listening.
Bread and butter.